Supermicro surged over 30% last week after announcing a multi-billion-dollar deal with a Saudi data center operator. However, some analysts are still cautious on this tech stock based on its falling profit margins. So, is now the right time to add SMCI to your portfolio, or should you wait a little longer? In this video, I'm going to cover the latest details with Supermicro and see if this stock is ready to buy. Supermicro rose 19% in midday trading last Wednesday, adding to Tuesday's 16% gain after announcing a multi-billion-dollar deal with a Saudi data center operator. The rally comes on the heels of a bullish coverage initiation by Raymond James, which is betting big on the company's role in the AI hardware race. Raymond James Financial initiated coverage of SMCI stock with an outperform rating and set a $41 price target, reflecting further upside from last Tuesday's close. The firm noted SMCI's strategic positioning in the $145 billion AI infrastructure market, where it currently holds a 9% market share. SMCI stock has climbed nearly 50% in 2025, far outperforming the S&P 500 index. The latest rally was triggered by a $20 billion agreement with DataVault, a Saudi Arabian data center company, announced last Tuesday. Supermicro's partners Nvidia and AMD also moved higher last week after unveiling separate AI collaborations with Humane, an AI subsidiary of Saudi Arabia's sovereign wealth fund. SMCI's product lineup, which includes GPU-dense servers and liquid cooling systems, has made it a key supplier in the AI gold rush. With firms like Nvidia and AMD depending on scalable hardware solutions, SMCI's ability to rapidly customize and ship high-performance computing systems currently gives it a competitive edge. Raymond James emphasized SMCI's nimble and vertically integrated model as a major reason for its optimism. The firm expects the AI infrastructure segment to remain in hot demand throughout 2025 and beyond, which could directly benefit SMCI's top and bottom lines in future quarters. SMCI's Tuesday rally not only put it among the top market performers, but also highlights growing investor appetite for AI hardware suppliers. While many pure AI stocks have struggled in 2025, SMCI's diversified revenue model and exposure to essential infrastructure gives it a unique advantage. However, while the stock price action was super strong last week, SMCI's recent financial performance does offer doubts for some investors. For example, net income for the third quarter ending March 31st, 2025 fell 73% year over year, coming in at $108 million, down from $402 million. In contrast, net sales increased 19% year over year, reaching $4.59 billion, up from $3.85 billion in Q3 2024. Now, another key metric investors should consider when looking at a stock is its gross profit margin. Margin tells you how much of every dollar of revenue is left after costs of goods sold to help the business cover its overheads and other operating expenses. A low gross margin is okay if a company sells in large volume, but it's not easy to maintain a healthy business. In Supermicro's case, gross profit margins have been trending down for over a year. This is a problem because while the company is growing its top line, it isn't necessarily making progress towards profitability. On face value, the company's most recent earnings report showed an impressive increase in net sales of 19% year over year, reaching $4.6 billion. These strong sales were based off its strong demand for its storage and server solutions. However, a closer look at the numbers reveals SMCI's gross profit actually declined to $440 million, a worrying decrease of 26%. The reason for this large loss in gross profit comes down to the company's gross profit margin falling considerably, from more than 15% to less than 10%. Consequently, increase in revenue was more than offset by a decreasing margin, and Supermicro earnings are also going in the wrong direction. This past quarter, quarterly net income totaled less than 108 million, its lowest level since 2023. Whilst earnings can fluctuate from one period to the next, it is a troubling trend for the business and may turn off investors. The danger is if companies' profits don't improve, that could make it a more expensive buy, and that could be the case if it isn't able to strengthen its gross margins. The company is forecasting diluted EPS of 30 to 40 cents for the current June quarter. Now, if that were to hold up for the entire year at the top of that range, the company would post an EPS of $1.60. And based on a share price of $45, which was around last Thursday's closing price, that would mean it's trading around 28 times its future earnings. However, this projection does assume that spending on servers, data centers, and tech infrastructure remains strong, which is not guaranteed given the current macroeconomic conditions. So, overall, what does all this mean for investors and traders alike? In the past 12 months, Supermicro shares have fallen close to 60% and look like they're now on the rise after finding support at the significant low of $17 back in November 2024. Looking from a technical perspective, the chart looks bullish, with SMCI trending upwards. And currently, there is a short to medium term trading opportunity with a clear price target of $66. However, from a fundamental point of view, SMCI's profit margins remain slim, and this may be a concern for some long-term investors. With such tight margins, any sales growth it generates may not necessarily translate into a big improvement on its bottom line. And based on this important fundamental metric, some investors may want to wait for the next earnings report to provide more clarity on longer-term growth prospects of this company. If you've enjoyed my analysis of SMCI, please hit that subscribe button to support the channel. And if you want to look at trading opportunities with SMCI, watch this video next. Thanks for watching.